Hello everyone. I'll briefly present Westpac's credit risk management strategies and their effectiveness in 2024. Here is our contents. Our analysis starts with the current level of credit risk based on Westpac's 2024 annual report and Pillar 3 disclosures. The bank has maintained strong credit fundamentals. The non-performing loan ratio was just 0.24%. The impairment expense ratio was 0.07%, and total credit provisions reached to 5 billion Australian dollars. Most notably, its Tier 1 capital adequacy ratio was 12.5%, placing it among the global top tier. In addition, the bank supported over 47,500 customers with repayment assistance, helping to lower default risk. When compared with the other big three banks, CBA, NAB, and ANZ, Westpac's NPL ratio was the lowest, and the capital ratio was higher than ANZ and on par of the others. This reflects not only strong asset quality, but also effective credit risk strategies. So what has Westpac done right? It has implemented the strict loan approval procedures, dynamic risk-based pricing, and flexible provisioning to respond to economic changes. The core program has also improved internal risk awareness and the compliance culture across the organization. Moreover, Westpac has adopted AI tools to identify high-risk customers, improving early risk detection. Importantly, in 2024, the Australian regulator APIA reduced Westpac's operational risk capital add-on from 1 billion to 500 million Australian dollars, a clear recognition of its improved risk management. In summary, despite economic challenges, Westpac has shown strong credit risk control through careful lending, customer support, and a solid risk culture. Next, please.
The second part is the comparative analysis. Compared with its credit risk management in 2023, Westpac has shown several areas of concern. Specifically, regulatory expected loss surges from 4.1 billion to 4.5 billion, and specific provisions rises from 1.4 billion to 1.7 billion, mainly driven by increases from the defaulted population, mostly from mortgages and downgrades of single-name exposures. Besides, actual losses increased from 410 million to 430 million, which is caused by higher direct write-offs from credit card exposures, partly offset by write-offs from individually assessed provisions. Next page, please. As regards to Westpac's endeavor to manage its credit risk profile relative to other three big Australian banks, namely CBA, NAB, and ANZ, there are commonalities and differences that demonstrate their respective risk management philosophy. The big four banks demonstrate commonalities in credit risk governance from three dimensions. The first dimension refers to three lines of accountability model. It clearly lays out the relative functions of business risk control and mitigation strategies, segregation of duties and responsibilities, and the role of independent internal audit. Second dimension refers to the capital. They establish credit concentration frameworks that set exposure limits to counterparties and require holding adequate provisions for defaulted and high-risk counterparties and exposures. The third dimension refers to the continuous monitoring. They hold regular monitoring of credit quality, concentrations, arrears, policy exceptions, and breaches, and make stress testing for counterparties and portfolios. Next, please. As for the disparities, Westpac innovatively proposes different credit risk analytic approaches, for retail and corporate clients, respectively, while integrating its internal rating systems with Moody's external rating system when making calculations of the probability of default and several other big figures. This creates a channel for comparing internal ratings with external ones, making it more applicable and universal to a greater extent. Next, please. However, other big banks also have their respective edges. For example, NAB makes very detailed analysis of how interest rate may deteriorate its credit risk profile in the short term via accelerated increases in defaulted loans. Besides, it details specific implications of various external events such as macroeconomic, geopolitical, nature-related, and social considerations. In general, Westpac is experiencing challenges of credit risk management, manifested from surging regulatory expected loss and actual loss, resulting from mortgages and credit card defaults. It is exerting innovative and extensive efforts in improving its credit risk profile, which is worth to continual observations, especially considering fierce competitions from other big banks. Next page.
Okay, an analysis of Westpac 2024 annual report and Parallel 3 disclosure shows that the bank's overall risk management is solid, with specifically strong credit risk controls. As of 2024, Stage 3 loan balance stood at 10.3 billion, just 1.27% of total assets. Its CET1 Level 2 capital adequacy ratio was 12.49%, well above APRA's minimum requirement of 10.25%. Westpac sits aside 5.08 billion in total credit impairment provisions of the year, including 1.7 billion in Stage 3 provision, and maintained a total loan coverage ratio of 0.5%. This figure highlights the bank resilience in the face of interest rate swing and a broader economic pressure. Next page, please. That said, Westpac still has noticeable gaps when it comes to AI-driven risk management. The annual report and CEO's message shows that the bank hasn't yet built a strong closed-loop system of areas like governance, answering bias checks, and modern validation. The CEO talks about AI's value for automation and personalizing service, but doesn't explain how those tools will be properly engaged and controlled within the current risk framework. The risk management section in page 40 to 47 refers to general model validation and third-party audits, but it doesn't clearly address AI-specific risks such as explainability, data draft, and Israel bias. Nor does it outline clear plan to manage it. Next page, please. Westpac should take lessons from First Republic Bank, which failed to spot risk like asset concentration and interest rate mismatch earlier in utility occupies when capital flow quick out. To avoid similar issues, Westpac should set up a cross-independent AI risk governance committee to manage AI models throughout their entire life cycle and put strong checks in place of model validation, transparency, and fairness. Second, build an AI-powered, real-time earlier warning system to spot sudden or non-linear risk like swap shift in market sentiment. Third, board and senior management accountability for technology risk, making sure AI and data risk are part of their strategic oversight and that the bank's technology strategy match its risk appetite. If Westpac can take this step, it will be in a much stronger position to deal with the challenge of new technology and tight regulation. This will help the bank stay steady through change, keep customers and investors' trust, and support long-term growth. Thanks.
Now, let us make a conclusion. Based on the analysis from my 3 classmates, the credit risk management of Westpac Bank is generally sound. The non-performing loan rate and other related indicators are at a relatively high level compared to the other 3 banks in Australia. However, there are still some shortcomings when compared year-on-year. Compared with 2023, expected loss and impairment preventions have increased. Mortgage loan defaults and credit card bad debts have risen, indicating that there are still deficiencies in risk identification and prevention in certain areas. In addition, Westpac Bank failed to fully assess the credit risk that may arise from external shocks such as rising interest rates. Please next page. Meanwhile, in the context of rapid development of the artificial intelligence, Westpac Bank should leverage the power of AI and big data technologies to enhance its ability to predict default risks, conduct real-time monitoring, and strengthen the monitoring and early warning of high-risk loans. It should quickly adjust policies and improve the efficiency of bad debt disposal to strengthen risk management, achieve early detection and intervention, and thereby comprehensively enhance the level of credit risk management. Next, please. There are our limitations of analysis. First, in the analysis of Westpac Bank and its peer, only the annual report for the year 2023 and 2024 will refer to. This result means less data, leading to structural deviations. Second, credit risk may work together with other types of risks to make impacts on the group, which deserves in-depth analysis in a spirit subject to derive an objective overview of Westpac's overall risk management landscapes. Finally, the specific impacts of external environmental changes on credit risk management have not been thoroughly examined. Factors such as global economic downturn and geopolitical conflicts may have significant effect on the credit risk of Westpac Bank. Next, please. There are our references. Thanks for listening.